Alok Agarwal joins us, Quant Fund Manager with Alchemy Capital. I have silence on my lips. I don't know how to react to this market fall. Even you are quiet. Looks like everybody is getting speechless.
No, absolutely. When you have a 5 consecutive month fall, and that's not seen in 29 years, obviously, it's painful, and obviously it's testing the patience of investors across the breadth. And nothing is being spared across the board. Everything has been coming down.
Why are markets down? I mean, last time when this kind of an carnage happened, it was something went wrong somewhere. A macro event, a terrorist event like 9/11, an unfortunate breakout of pandemic. These falls have happened when the world or the shape of the world has changed. Right now, nothing has changed, and yet markets are down.
Absolutely, that's the point that's surprising everybody. Usually, it is said and been well written as well that the most corrections ever, also the deeper corrections, they all come with a new reason, new style, new ways. But this time, without a major crisis, no scam, no defaults anywhere. Yes, there was a slowdown in the corporate earnings. There has been a slowdown in the economic growth. But yes, the reaction, sometimes on the upside is also a little exaggerated. Sometimes on the downside is also exaggerated. We are seeing both in a very short span of time.
What is the way forward? I mean, is it time to now start buying risk, or the narrative in the market could remain weak for long, and we should not expect anything magical now?
Sentiment definitely remains on the negative side, but it's very easy to lose sight of positive data when a market sentiment is negative, the way the negative data is overlooked when the sentiment was extremely positive. We had a great 4-year period of FY20 to FY24 where the corporate earnings were growing steadily above 20% annualized almost. But the June quarter and September quarter numbers came in at single digits. We had 5 out of 7 months of GST collections coming at single digits. That's where the slowdown picked up. But now with the negative sentiment on so much, one of the data points like GST collection in the month of Jan being at 12.3%, which is the highest since April, that has almost gone unnoticed. Yes, the corporate earnings results this quarter also were not too great, but at least they were much, much better than the last 2 quarters, with Nifty 500 reporting an adjusted profit growth of close to 12%. So there are certain green shoots, plus with the RBI being quite proactive on managing the liquidity and the growth side, there are a lot of green shoots and the recovery signs getting available. Of course, the speed and the pace at which the overall market is getting corrected obviously dents the sentiment. But these are those great times when adding to the portfolios, building portfolios, adding onto them actually proves to be providing disproportionate returns 1 year, 3 year out.
Hi Alok, this is Srishti also joining in. Talk to us about the consumption space, Alok, because we believe that consumer discretionary specifically is the theme that you have been liking. And given the fact that in the recent fall, all these stocks have participated, the kind of enthusiasm we have seen with respect to the budget announcement, that is also seemed to be waning away. And these high PE counters are feeling the most of the burn. Help us understand that how are you approaching this space particularly, and what is the way forward?
Srishti, hi, good morning. Consumption space, as you rightly pointed, the discretionary space is the one that we are most bullish on. The structural part of it comes from the fact that India being a $2,500 per capita income economy, and which we keep growing at close to 10% per capita income, 10% income per year, the discretionary side of disposable income available keeps rising. That's where the consumer discretionary is likely to do much, much better, even in 5 years, 10 years out. Yes, certain smart events in the shorter term act as a further catalyst, like the one you mentioned in the budget. We are positive on the whole space, be it the whole discretionary space, be it right from consumer durables or the autos or the retail side, and in fact on some of the technology platform related companies as well, which is actually serving on the consumer discretionary space. You also pointed rightly that some of those companies have actually come down for a big correction. Actually, correction has been there across the board. We did an analysis as to whether the correction is more in the high PE stocks or the low PE stocks, there's almost no difference. A low PE stock may have corrected on an average by 19%, where a high PE stock may have on an average corrected 20%. The gaps are quite minimal. So it's not on the basis of a sector. It's not on the basis of a particular P ratio. Yes, the markets have seen an overall correction, but what makes sense at this point of time is when you rebuild portfolios, when you add to the portfolios, it's important to add to those areas where the growth visibility in near term, medium term, and longer term are good. The quality of managements are good. And that's where consumer discretionary really, really stands out.
You have a lot of manufacturing stocks in your portfolio. They did very well. But is it time now to just say that the best of the manufacturing stocks, whether it is a Dixon or a Keynes, or for that matter, even Dynamic Technologies, which Alchemy has really held on for many years now, is that sugar rush over?
So let's put it in this way, Nikunj, when we look at the capex side of it, and certain part is manufacturing side. When the manufacturing side is for the discretionary consumption side, like the electronic manufacturing, etc., I mentioned, those are still very, very positive. But there is some kind of consolidation in the capex side, the primary data being that from FY16 to FY20, the capex growth in the Indian budget happened at around 7.5% annualized. But from FY20 to FY24, it accelerated to 30% annualized growth. That was a big, big number spread across multiple sectors. But from FY24 to 26, it is again consolidating at around 8.5%. That's where the markets are trying to readjust. The view on the longer term is much, much better on the capex side because the focus of the government has been there to increase the share of manufacturing in the GDP, to focus on the capex. It's not come down at all. India capex in FY19 used to be 3 trillion rupees. In FY26 is budgeted at 11 trillion rupees. It's almost a 4x number in a 7-year period. That's a big, big number. But when markets see a 30% growth for a 4-year period, thereafter looking at an 8.5% number, that looks like a dampener over a shorter term. But after a lot of companies reporting multi-year kind of an order book, some execution is required while the government shifted focus more on the consumption side to balance out the economy.
Okay. So what are the key changes which you will do in your portfolio now? Considering between October and now the world has changed, trade orientation has changed, growth assumptions have been reset. Where do you think it's time to say, okay, the best is behind us, and where are you likely to move by assuming that the best is yet to come?
So let's put this way, Nikunj, from capex-oriented names to consumption-oriented names. More importantly, from outward revenue-generating kind of companies to domestic-facing companies. See, if we take examples of certain sectors which may not have adequate representation in the larger indices, things like, say, hotels or hospitals or the capital markets, and you also mentioned the electronic manufacturing companies, these are all very, very domestic in nature. Their demand, supply, the whole value chain, everything is dependent upon the whole domestic side, which is quite insulated from the developments that are happening globally. And these companies, these segments have a long runway of growth as well. So the segments that are more domestic, more consumption-oriented are the ones that we are more positive on. Consumer discretionary, I just mentioned, and also there are a lot of spaces in the healthcare.
But Alok, also talk to us about your take on the financial space, because in this market correction, that is one space, at least where the consensus call is coming, that is giving comfort to the fund managers. But given your portfolio and your allocation, seems like this is not the theme that you are betting the most amount of it there. What's your sense on the financials?
So on the financial side, the lending space was not doing that great. Till about December end also, if you look at 10, 11-year figures, the private bank index actually underperformed the Nifty 500 over a 10-year period as well. So right from the credit growth being slow with net interest margins kind of some kind of attack, and the credit costs being at decadal low, those numbers were not giving too much of comfort. At the same time, the deposit growth wasn't picking up. One of the very interesting things that happened in the budget was with that exemption limit being raised to the 12 lakh numbers, although the consensus numbers were talking about the tax saving amount, but what we would also read through that is that it could be an incentive to a lot of people in the parallel economy to actually move towards a formal economy. And the signs of that will come through when they start depositing that cash into the banks. Once we see those numbers coming in right from April onwards, that could be very, very positive for the economy as a whole, but that would be also filling a major gap for the banks because they're struggling for the deposit growth to come through, and that can ensure that deposits come through. So some of those selected private banks could be very good at this point of time. But in the financial space, our bigger positive view is on the capital market space, right from the whole value chain of broking to wealth managers to the asset managers and the exchanges. So those segments, we feel that we've seen that the penetration has been rising. The earnings growth are quite good, and the runway for growth for the next few years also looks pretty strong.
But Alok, in this recent fall, also give us a sense that where are you deploying the money, if at all?
As I said, the primary one being consumer discretionary, some hotels, the hospitals, the capital marketplace. These four are the main areas that we are seeing more deployment, and some of the select names in the technology space as well.
Let's understand what should one do now? I mean, okay, the damage has happened. I wish I would have sold in Jan or December. That is what everybody is saying. The point is, most of the portfolios are down 25 to 30%. If you don't sell now, is it a good idea? Or it is time to sell and save? What is better?
Nikunj, although timing the market is quite an exciting thing to do, can give a lot of adrenaline rush also. But I don't really think that anybody has a clear view idea as to this is the exact bottom or these are the exact number of days for which it can fall. All we can say is that yes, markets were reacting to a number of developments globally and locally. Earnings slowdown, the slowdown in the economic growth, the election in the US, and then developments on the China side as well. But with the growth numbers coming back, with the GST collection numbers showing green shoots in terms of economic growth under a recovery, and more importantly, the baton of growth and liquidity being with the RBI, who's being quite proactively supportive, the odds are changing more in favor of reward rather than in favor of risk. Yes, one may have to take a dent of a few percentage points or for a few days. It's difficult to say. Our sense is we are very close to the end of this correction. But it's very difficult to take out that this is the exact time or not. We generally believe that being invested is a better one, a better strategy to be in, because the bounce backs can also be pretty sharp.
Yeah, absolutely. But Alok, great having you on the show and getting in your thoughts on where you feel the markets are headed next.